behalf of all the webinar organizers, I would like to welcome you to the first session of the AI and Big Data in Finance Research Forum. We have prepared an exciting lineup of speakers and discussants, and hope that this monthly webinar series will provide a platform to showcase the most important applications in finance and economics of this young but very fast-growing field. For all the up-to-date information, please check our website. Today, we are very happy to welcome Stefan Nagel from Chicago and Ken Daniel from Columbia to talk about market efficiency in the age of big data. There are 35 minutes for the presenter and 15 for the discussant, followed by questions with the audience. Please send us your questions via the Q&A option. Once the official recorded part of the seminar is over, we hope you will be able to stay online and join us for an informal follow-up discussion. And now, Stefan, the floor is yours. Would you like to share your slides?
Yep. Can you see the slides?
Yes.
Yes.
And they are moving?
They're moving.
Okay, perfect. So thanks a lot for giving me the opportunity to kick off the series with a talk. The paper I'm going to talk about is joint work with Ian Martin at LSE. And what we are interested in the paper is trying to think about how investors navigate a big data environment where they face a lot of information that they have to digest. And in particular, we're going to think about the problem that investors face when they want to forecast cash flows of firms and companies. And maybe 100 years ago or so, this was not just such a big deal when the number of variables that were available to investors for predicting cash flows was relatively small. But in recent decades, there was clearly kind of a big data setting here. If you just think of the SEC Edgar database, for example, and you do some fancy analysis on the information that's in the database, like doing texture analysis of the textual information there and things like that, you could probably construct 1 million different variables for each firm, where many of these variables could potentially be relevant for forecasting cash flows. And now the question is, if investors want to use this information productively for valuing stocks, they need to somehow use this information to construct expectations of future cash flows, right? And to construct these expectations, investors need to map these predictors into expectations. And doing that requires knowing what sort of function maps these predictors into expectations, what are the parameters of that function, and so forth. And that's basically a high-dimensional learning problem. And what we want to investigate in this paper is what are the consequences for asset pricing when we put investors in such an environment? What does this mean for how we should interpret market efficiency tests? What does this mean for how we should go about estimation of risk premia in the cross-section of stock returns, for example? Now, if you think about our standard theories in asset pricing, this problem is usually not popping up because in at least our most standard theories, the problem is entirely assumed away, right? A lot of our asset pricing models are based on rational expectations, rational expectations models where it is being assumed that investors already know this function f that maps predictors into cash flows. Yeah? And virtually all of our empirical machinery in asset pricing is built on these rational expectations models, right? So tests of market efficiency, estimation of asset pricing models based on Euler equations, all of this is kind of based on this rational expectations foundation. What we show is that when you put investors into a high-dimensional environment and you let them learn about this function, this actually has quite drastic consequences. For example, you can find lots of types of in-sample return predictability, even if there's no risk premium or no behavioral bias or no mispricing in that sense in the model. And if you want to tease out risk premium or mispricing from asset prices in this kind of world, you really need to focus on out-of-sample return predictability. Yeah? And the high dimensionality of investors' learning problem basically increases this wedge between in-sample what in-sample return predictability tests tell you and what out-of-sample return predictability tests tell you. Okay, now before I go into the model and the analysis, let me just at the outset emphasize one thing, which is kind of important to understand for understanding what we do here. So even though there will be things popping up in the paper like asymptotic analysis and asymptotic properties of test statistics, this is really not an econometrics paper, right? In a typical econometrics paper, you would take as given some data generating process for returns and then think about properties of test statistics. What we are looking at here is we want to think about what happens to equilibrium asset prices if dimensionality gets big, and when you do asymptotics towards big dimensionality. And so this is in that sense a fundamentally different analysis. Okay, I'm going to look at this now in two steps. The first step is to set up a model in which investors learn about the parameters of a cash flow generating model, and then they price assets accordingly based on their beliefs. And in the second step, then we are going to imagine an econometrician that comes in and analyzes now these asset prices ex post using kind of standard empirical asset pricing machinery. And then we're going to think about the properties of these tests that the econometrician is looking at. Okay, so here's the simple asset pricing framework. Yeah. Our goal with this is basically to set up a model that is as simple and stark as possible, that you can still discuss these kinds of effects, right? So some features here will not be entirely realistic, but again, we're trying to get at this in the cleanest possible kind of setting. And so we're going to consider an economy with n assets. You can think of them as stocks, and each one of those comes equipped with J firm characteristics. And then so in this whole panel, in this whole cross-section of firms, we can collect all of these firm characteristics in one big matrix that's of dimension n times J. Yeah? And we're going to keep J smaller than n. This is mostly for notational convenience. It would be easy to accommodate also even J bigger than n, but it would require an additional dimensional reduction step that investors would have to put in there. But it wouldn't fundamentally change things, really. And these characteristics now matter for the cash flows that are being produced for each firm, right? So each firm is going to have some dividends, and we collect these in this vector y. And what we call the growth rate, but it's really just the first difference of these dividends, is partly predictable based on these characteristics in the X matrix. And what is now crucial here for what's going to come is there's a parameter vector G that maps basically these characteristics into the forecastable component of these dividend growth observations across firms. Yeah? And so this parameter vector G is everything we do in our analysis is going to basically revolve around how investors go about estimating this G parameter vector. Investors are homogeneous, risk neutral, and the interest rate is 0. So there's no reason for any return predictability aside from effects of learning that are being introduced here later. Again, to keep things as simple as possible, we're going to price very simple assets. You can think of them as dividend strips. They're basically just a claim to a single dividend in the future, and then collected across all firms in a cross-section. We then have a vector of these dividend strip prices that are claims to prices of claims to dividends in the next period. You could still think of the model as roughly applying to stocks if you just think about all of the cash flows that a stock gets over their lifetime as sort of collapsed into one payment maybe 10 years from now, and then one period in the model would be something like 10 years. All right, so as a baseline, let's first understand how this would play out in a rational expectations setting where investors know the value of G, right? And so there would be very simple. They would be forecasting cash flows just as the current vector of dividends plus this forecastable growth component, and this would then be the price at time t. Returns, if you define them as just payoff minus price, would just be unpredictable here. And This is kind of the usual null hypothesis that we have in market efficiency tests, Euler equation-based estimation, and so on, that there is an unpredictable, that are unpredictable innovations that are orthogonal to, time t information and so forth. Okay, but now we want to know what happens when investors have to learn about this parameter vector G. Okay, so we're going to put these, we're going to assume that these investors are Bayesian. And so they, before looking at the data, they have some prior beliefs about this G vector. And you can see these elements of G are centered around 0, and there is a covariance matrix. The covariance matrix is proportional to the identity. This is not really important because we could always rotate and rescale X to make this hold. What's more important here is that the variances decline with J, as you can see here. Now, why do we do that? Well, later we're going to do asymptotics where we're going to let J and N get big. And so if we didn't have these variances shrinking with J, we would get into a situation where asymptotically, the predictable component of cash flow growth would just explode, which doesn't really make any economic sense, right? That somehow most of cash flow variation becomes, extremely predictable. And so what we really need is just asymptotically that this kind of flattens out and doesn't explode. But to make it really simple, we just hardwire this in this way. Yeah? And so this ensures that when we later take a limit, that the variance of predictable cash flow growth doesn't explode. Okay, and then investors are going to learn about G just by observing the history of past dividend growth observations. Since they are generated based on IID shocks, we can just summarize this entire information from these past periods in a vector of sample average dividend growth, right? Okay, so this is the prior and how investors learn about G. And so here's how the posterior mean looks like. It has an intuitive interpretation. Investors' posterior mean is basically an OLS estimator and then shrunk towards 0, towards the prior mean. Yeah? So the OLS estimator is basically regressing just dividend growth observed in the past in the cross-section on these X, on these characteristics. And then it's being shrunk towards 0. And the shrinkage reflects the influence of the prior mean. Yeah? Here's the expression for that gamma matrix, the shrinkage matrix. But let me just tell you what sort of forces show up in that shrinkage matrix. Yeah, when do you get strong shrinkage? You get strong shrinkage if T is small. So investors haven't seen a lot of data yet. That's kind of natural. Then the prior retains a lot of influence. Shrinkage is strong if theta is small. So this means the prior is tightly concentrated around 0, right? A very strong prior in a way. And shrinkage is strong if J over N is large. So if there's, relative to the number of assets, a large number of predictors out there. And then, along principal components of X, the X prime X matrix with small eigenvalues. Okay. All right, so this is how investors form beliefs. And now you can easily then look at what sort of asset prices are being generated here. And based on these asset prices, we can compute returns. Yeah. And returns have now 3 components with an intuitive interpretation. So you can see there's the first component here. And this basically shows up if there is shrinkage. So if this shrinkage matrix gamma deviates from the identity matrix, then there's shrinkage going on. And you can interpret the effect of shrinkage kind of, like an underreaction. There's not truly underreaction because these investors are Bayesian. They're doing the optimal thing. But you could interpret this as a kind of underreaction to the information that is in X about future cash flows. And because there's kind of this underreaction, there's a component related to X that remains in returns that was not incorporated into prices. Now, why are investors doing this? This is optimal. They are Bayesian. They are doing this because shrinkage, while it generates this first term, it helps make smaller the second term. What is the second term? The second term is basically the effect of estimation error, right? So just by chance, some of these past noise observations in dividend growth are going to line up cross-sectionally with these X's. This introduces its estimation error, and shrinkage, you see the gamma matrix here, makes that term smaller, Yeah? And a Bayesian investor basically achieves the optimal trade-off between generating this first term and reducing that second term. And then the third component is just the unpredictable shock, which would be the only term showing up in returns in the rational expectations case. All right, and so these are asset prices. And now we want to know what happens when the econometrician now goes in and studies the properties of these returns. So we imagine an econometrician that now comes in, takes these returns. This equation just repeats what I showed you on the previous slide, how these returns look like. And the econometrician takes these returns and regresses them cross-sectionally on these characteristics in X. Yeah? Now, naturally, the coefficients, the regression coefficients that the econometrician is going to get are going to inherit these three terms that show up in returns. Yeah. So again, kind of the shrinkage term, the estimation error term, and then kind of the pure noise term. Okay, and what we now want to know is how likely is it that the econometrician is going to find that the elements of this regression coefficient vector are jointly significantly different from zero. To get some closed form solutions here, we're going to do this with asymptotic analysis. But keep in mind, of course, the whole purpose here is really just to get an approximation to a realistic finite sample situation, right? So don't think about this asymptotics as in a sense too seriously, in the sense that we are really saying here, the number of characteristics is infinity. Yeah? But I'll later also show you some evidence from finite sample simulations that these asymptotic results actually do provide a good approximation to what's happening in a more realistic finite sample. Now, how are we going to do asymptotics here? Sort of standard way, often in econometrics settings, would be in a cross-sectional setting to have n go to infinity and have j fixed. This would not make any sense for our purposes here, because this would mean that asymptotically, investors' learning problem would kind of go away, right? Because the number of observations explodes relative to the number of parameters that they have to estimate. So instead, we're going to look at an asymptotics where we let the ratio of number of predictors to number of assets approach a constant in the limit. Yeah? And this means that even in this asymptotic limit, this vector G is still uncertain in investors' minds. So there's still a meaningful learning problem. But through all this, now keep in mind that when we think about n and j going to infinity becoming big, this changes not only the sampling properties of a test, but it also changes the properties of asset prices, right? Relative to a small, for example, a small j setting. Okay, now we let the econometrician basically test whether these coefficients in these regression coefficients are jointly equal to zero. And the econometrician could do this with a chi-square test. For our purposes, it's useful to rescale this chi-square test to be asymptotically normal under rational expectations. And so this is what this test statistic TRE is here. Right? That thing would be standard normal distributed if asset prices were generated by rational expectations investors, and we take this limit that I just described, with both n and j going to infinity and j over n going to a constant. Yeah? So this would have, in a sense, standard properties, right? You could do a standard based on asymptotic standard normality. You could easily now test this. Yeah? But the question now is, of course, how do the properties of this test statistic look like if asset prices are not generated by rational expectations investors, but instead by investors that have this Bayesian high-dimensional learning problem that I described earlier. Okay, to figure this out, what's going on in a learning setting, there's one more important thing that we have to pin down now, which is what is the actual distribution from which the elements of G are drawn from? So far, I've only described to you what the investor's prior is. I haven't said where this G actually comes from, right? So we imagine that at the beginning of the world, nature draws a G vector. And so in what I'm going to show you now, we're going to assume that G is drawn from the prior distribution. And so in this sense, investors here have an objectively correct prior. And this is in a way a form of hyper-rationality, right? There's nothing in sort of, axioms of rationality that says that investors should have an objectively correct prior in this sense. But it does minimize the amount of return predictability that is there. If you allow investors' prior to deviate from the objectively correct prior, this would introduce additional sources of return predictability. Okay, so let's look at what happens to this test statistic in the asymptotic limit. The formal proposition is here, but it's better if we, better to illustrate if we present this a little differently. So you can think of this test statistic of the econometrician as basically being this standard normal distributed random variable that it would be under rational expectations, but now scaled up by the square root in front of it, which turns out to be a number bigger than 1 always, right? So it gets more variable. But then most importantly, there's this additional term here that grows with the square root of j, right? And so if now an econometrician comes in and does a test, assuming that thing has a standard normal distribution, but there is actually this term growing with j, this means that the rejection probability, of course, is basically going to 1 in the asymptotic limit, right? So in other words, the econometrician is very likely to conclude from a test like this that there is return predictability there. We can also do this much simpler with a kind of a trading strategy type of approach, right? So the econometrician could take these regression coefficients from this cross-sectional regression of returns and characteristics and use those to form predicted returns for every asset. This is just x prime h, and then use these predicted returns as weights for a portfolio. And in an in-sample evaluation, the returns that are being used in that portfolio would be the same returns that have been used to estimate these regression coefficients, right? This is what we often do in empirical asset pricing, where we estimate some relationship between characteristics and returns over a certain period, and then construct a trading strategy over that same period, and then look at its average return and its Sharpe ratio. Okay, so this is an in-sample test. And this in-sample trading strategy here in our setting would have in the limit a bigger than 0 expected return, and this mu here is a number bigger than 1, and its Sharpe ratio would explode in the asymptotic limit. Although the exploding Sharpe ratio is really an artifact here of the fact that we didn't put any factor structure on these residual innovations of cash flows, right? So that's, I think you could get more realistic if without exploding if you put some factor structure on that. What is going on here? Why is there a non-zero or a bigger than 0 expected return? Well, this reflects the look ahead advantage that the econometrician has here in these in-sample regressions, right? And this, what basically happens is when we go to this big data setting, this look ahead advantage that an econometrician has by seeing data that investors don't have in real time, it basically gets bigger, right? The more difficult investors' learning problem becomes, the more valuable, in a sense, it is for the econometrician to see data exposed that investors didn't see in real time. Now, what could an econometrician do who is trying to get a sort of a test of whether returns are sort of, may have some risk premium or some mispricing that would go generate return predictability beyond these learning effects that induce in-sample return predictability? And the answer there is the econometrician would have to look at out-of-sample types of tests. Okay? So let's have a look at this. We're slightly generalizing here now and saying that the econometrician might use the full matrix X as an out-of-sample predictor, but maybe also just a subset of this X matrix or something that spans part of the X matrix or something like this. And so we collect these characteristics in C. And then we have the econometrician run regressions in some period S+1 of these returns on these characteristics. The econometrician gets some coefficient vector B. And then we ask, what is the relationship between the fitted values from this regression, kind of the predicted predicted returns for every asset and the actual returns in some other periods that was not used to estimate these coefficients B. Yeah? And the answer there is there's basically no relationship. The expectation is 0 here. I use those special cases, again, a trading strategy, right? So you could have the econometrician estimate coefficients in some period S+1, use the fitted values from the regression to construct portfolio weights, and then apply these portfolio weights to some returns from some other period that was not used in the regression that generated the B coefficients. Yeah? And this trading strategy now would have an expected return of 0. Okay, now one thing that is kind of interesting here is potentially is that this actually works backward as well as forward, right? So the out of sample here doesn't have to be in a forward sense. It also works backwards, that the econometrician could take data from the future, estimate a regression there, and then apply these regression coefficients to some data in the past to construct a portfolio there. And the forward case is very natural because investors here are Bayesian. So if the econometrician avoids the use of look-ahead information, the econometrician just cannot beat investors in real-time return prediction. That's very natural. The backwards case is a bit more surprising. It's clearly not a tradable trading strategy, but it's still interesting to think more about this for academic research, because sometimes in academic research, we do these kinds of things. We do backwards out of sample testing. There's also cross-validation approaches around in the literature, which also combine forward and backward out of sample prediction. And so for interpreting what these kinds of things do, it's this result here is kind of interesting. But I'd also like to caution here that, while we think the forward result is sort of a very general property of Bayesian learning, the backwards result is probably to some extent specific to the environment here, but we don't know yet exactly to what sort of features of the environment here, right? So this is still something to be worked out. Okay, so how can the econometrician go about testing for out of sample predictability, right? So we have this result here about the expectation, right? That holds, but how does the econometrician now test? Could the econometrician test this? We need, roughly speaking, a standard error for this. And this is where it gets a little tricky, and there's still more work to be done, I think, in this area. So in a model, we can compute a variance that depends on eigenvalues of this X prime max matrix and other things that would give you a standard normal distribution for this out of sample return. But the problem is, how would the econometrician construct this in practice? And there's sort of a very fundamental problem appearing here, which we don't have a solution for, but I just want to highlight this as something that is, I think, worthwhile thinking about more for these kinds of learning models and how to map them into data, right? The result, and here's the problem, the result I showed you earlier is that the expected out of sample return is 0. But this expectation is an expectation that kind of not only integrates over these innovations of dividend growth, these e-shocks, but it also integrates over the prior. So there's an expectation taken over, basically rerunning the world for different values, different draws of this G vector, right? Imagining hypothetical redrawing of this G vector and then averaging across all of these worlds. And this is something that an econometrician could, of course, never do, because an econometrician only sees one run of the world where nature initially drew a G vector and that's it, right? And so an econometrician can only see this. And so if you're looking at if the econometrician is now looking at variation of this out of sample return in that one sample, it's not going to capture that variation across these different worlds for different draws of G that you would really need to construct this variance that is showing up here in this statistic. We have a heuristic solution for this that at least on average gets it right. If you compute a variance from just the sum of squared returns, or the average squared return, and that is not centered, then at least on average you get this variance right. But in a particular sample, it could of course be off. Anyway, I just wanted to highlight this as sort of an interesting issue that I think is worthwhile thinking more about. Okay, Now, a practical problem would now be, if an econometrician now acknowledges, yes, investors face this learning problem, in an in-sample return predictability test, I might be picking up these learning-induced effects, but I still want to tease out from the data some risk premia that might exist or some persistent mispricing that might exist. How can I do that? So we're not going to generalize the model here all the way to putting in risk-averse investors and risk premia and so on. For now, we just do this in a very simple way. We're just saying, suppose there's an additional component in returns that could reflect mispricing or risk premium that's related to these characteristics. Yeah. And then maybe the econometrician maybe doesn't observe all of these x's. Maybe the econometrician just sees C, so maybe a subset of x, right? And the econometrician would now would like to estimate what is this component C times gamma that picks up risk premium or mispricing related to these characteristics. So more precisely,
Stefan?
Yeah.
You have 5 minutes.
Yeah, sounds good. Thanks. We're going to ask the question: how can the econometrician estimate basically the total contribution of this risk premium / mispricing component to cross-sectional variation in expected returns? Yeah. And there's sort of a very nice simple answer to this, which is it's just the expected out-of-sample return, right? So in that setting here, the expected out-of-sample return would precisely pick up this. And so this is basically telling us that if we think that this learning problem is relevant, then as empiricists, we should really try to focus on out-of-sample return prediction, because the out-of-sample predictable component of returns tells us something about persistent risk pricing and risk premia that we can then map back into models of risk premia and models of mispricing. Okay, the paper also has some simulations just to show you how that the asymptotic sort of is a useful representation of what happens in a finite sample case. We try to calibrate this in a sort of a rough way to be somewhat empirically realistic. I don't have time to show you all of this. Just want to show you maybe one or two plots. So in these plots, J down here on the x-axis is the number of characteristics that investors face. And this plot shows you the adjusted R-squared in the econometrician's in-sample regression. And you can see, as we go to a setting with lots of characteristics, these in-sample adjusted R-squareds go up, which looks like returns are highly predictable. These rejection probabilities, in a finite sample do go towards 1, like the asymptotic results suggested. We also have an analysis in the paper where we're working with a setting in which the model that investors are using to forecast cash flows may have sparsity. So when you do things with a normal with a Laplace prior, but not instead of a normal prior, you can get sparse models and so forth. But the conclusions from that are very, very similar. And then the model, the paper also has some results on sort of a simple empirical illustration of this wedge between in-sample and out-of-sample predictability, but I don't have enough time to go through this. So let me conclude here. I hope I convinced you that in a big data setting, this notion that investors know G already is kind of implausible, and learning about G has very strong effects on the properties of asset prices. Yeah. And one lesson that emerges from this is that we should probably focus a lot more on out-of-sample, not in-sample return predictability, if we want to map data from asset prices into theories of risk premia and behavioral biases. Yeah. This is, of course, an empirical challenge because a lot of our econometric machinery is based on in-sample testing, and there's still a lot more work to do to make progress on how to do out-of-sample types of analysis. And just much more broadly, I want to end with sort of pointing out one question for future research, which is much more generally beyond our specific setting here. One could ask the question whether some empirical phenomena out there that seem puzzling, whether they could be explained by agent learning in big data settings. And so the idea would be modeling economic decision makers basically as machine learners that digest high dimensional amounts of information. We did this here with a Bayesian framework, but that's not necessarily what one would have to do. One could really also have them use, machine learning techniques and other things to do that. Thank you very much.
Thank you very much, Stefan. The discussant is Ken Daniel. Ken, would you like to share your slides?
I will do that. Why is this not? There we go. Okay, can everyone see that?
Yes.
Okay, super. Let me rearrange my windows here. Okay, so this was a really fun and great paper to read and think about. There's a lot going on here. I was thinking this kind of about, I mean, it's two very much linked ideas, one about learning and how do we model learning, and the other about disappearing anomalies, which I think is what motivates this. And so what I'm going to do is I'm going to talk about kind of this in three ways. First, I want to talk about just give a quick look back at the data that I think motivated this. And, the area I work in is kind of low tech asset pricing, return predictability. So I'm just not sure everybody's aware of this data. So let me give you an overview of that. We'll talk a little bit about the model. And then talk about some challenges for the model. Now, to be fair, Stefan is not saying, this explains all the anomalies and all the changes in time variation of the anomalies. But what I think learning is incredibly important. This has got to be playing a big role. As probably some of you know, I worked in the industry for a while. And what you're always trying to do in industry is figure out what's going on. And I want to think a little bit about, how this model could be extended to estimate some of the other features that I think might be driving anomaly returns. Okay, so let me jump right in. First, this is a plot that I think is kind of cool. And this shows the FAMA French factors plus momentum over the period from 1963 through kind of the middle of the financial crisis, November 2008, okay? And if you look at this, these look like unbelievable investments. Okay, so what I've done here is I've taken each of these strategies, and these are just straight off of Ken French's webpage, okay? Basically what I've done is I made them investable. So in other words, you put $1 into T-bills, you put $1 into the long side, the H of HML, and short $1 of the short side. Only what I'm going to do is I'm going to adjust the amount of leverage. In other words, you're not necessarily investing $1 in the long and short side. You're putting more or less to equalize the volatilities for each of these strategies, okay? But this shows you how effective these things were over this period. So basically, if you put $1 into the market in July of 1963, you would have had $60 by the time you get to the middle of the financial crisis, despite the big drop in the financial crisis. This is just the power of compounding, right? But if you look at these other anomalies, particularly momentum, but certainly value, profitability, investment, all of those yield incredible returns and even more incredible Sharpe ratios, okay? So now what's kind of shocking, this shows the returns since the middle of the financial crisis, since November 2008, okay? Now you see by far the best performing over this last, 12-year period is the market. And everything else has pretty much been a disaster. Momentum's done, profitability's been okay, but everything else, and particularly value, $1 invested in the value strategy, again, volatility normalized, over this period, your dollar has turned into 28 cents. So this is what investors like, AQR and those types of firms have been struggling with, okay? Now, value in particular, because I'm going to come back to this, this shows 10-year rolling returns to this investment in the value strategy. Okay, so one of the really remarkable things you see is this was good starting at the start of CRIS from 1926. again, up through the financial crisis. And then once you hit the financial crisis, it starts crashing, okay? And the last 10 years have been a disaster. But again, if you looked prior to the financial crisis, you would have said, well, there's no 10-year period where this loses money, okay? The last 10-year period, you've lost 45%. Okay, so it's kind of a remarkable change. This table just summarizes that. So if you look at the returns, if you look at the Sharpe ratios in the pre-financial crisis period, they're all really good. Okay, if you look at the post-financial crisis period, the market has been phenomenal, and everything else, both in terms of returns and Sharpe ratios, has been a complete disaster. Okay, so what's going on? Well, this is obviously something that the literature has been paying attention to, and there have been a bunch of stories proposed to explain this. One story is kind of I'll attribute it to Cam Harvey, but these were never there in the first place. This is all data mining. We've got, hundreds, maybe thousands of researchers in finance, and we're all, I'm in there, plugging away, trying to find anomalies. And what do you know, I find some. So I'm not using a big enough cutoff because I'm not paying attention to the fact that there are so many of us working on this. Another story, which I'll attribute to McLean and Pontiff, and they're, very nice paper, but, other people have talked about this too, is, well, it's an arbitrage story. Though there were some investors pursuing these kinds of strategies, there weren't that many. And once they got published, boy, everybody found out about them. Everybody who was reading the finance literature started pouring money into these, and they got partially or fully arbitraged away, okay? So this paper is adding another story to this. And this is related to, I think, the Harvey et al. Story, but it's a very, very different take, a very cool take. So the idea is agents have to figure stuff out, right? I'm not sure I'd say this necessarily characterizes rational expectations models, but it really characterizes the way we do the tests. We do them in sample. If you think about Fama and French and their estimation of the value premium, they said, okay, let's figure out what the value premium is by looking at returns in their initial paper from 63 up through, I can't remember, the late 80s, okay? And if you just look at one period, that's not good, because what could have happened is investors were learning about the parameters of the process, which generates in-sample predictability. But then once you look out a sample, you don't see any predictability, which is certainly very much what we were seeing in those last couple slides. They were there when you looked in sample. Once you look out a sample, there's nothing there. Okay, so there are some other papers that look at some very cool explanations, by the way, that incorporate learning. Timmerman, I think, was one of the first. Llewellyn and Shanken looked at something a little bit related to this. The papers that Pierre and Mike Johannes and Lars Luxter have are related, but this is the first paper to really think about, could these cross-sectional anomalies, these cross-sectional strategies and the premium we attribute to these, could this be the result of learning? Okay, so I'll just talk just for a couple slides about the model. The model is very cool. The key feature is that the idea here is that investors are all rational in the sense that what they're doing is they're willing to pay for a security. In fact, they set the price of a security equal to the present value of all the future cash flows, okay? And here they're gonna do it with dividend strips, but same thing. So I always like to think about these things with an example. A new asset comes out like a SPAC, okay? And you've got a bunch of SPAC characteristics. They're brand new. How do you figure out what that's worth? Well, you know that you're going to you've got a bunch of characteristics summarized by X, okay? And what you want to do is you want to estimate the cash flows you're going to get out of each of these securities based on these characteristics, okay? The X's tell you about the future cash flow growth, but you don't know the coefficient that relates those X's to the cash flow growth. So you got to estimate that. Now you got a prior, okay? So what you're going to do is you're going to start off at the start of time, just using your prior, okay? But then later, once you see some cash flow realizations, Now, of course, what you'll do is you use those cash flow realizations to update your estimates of G. Okay, when you do that, prices change. So that gives you some predictability that's related to the X's. So if you're a dumb econometrician, okay, what happens is you come in and you say, look, returns are related to these X's. So we've got evidence of return predictability, which you'll attribute either to being a risk premium if you're Gene Fama, or to being mispricing if you're Dick Thaler, okay? Now, how big a deal could this be? Svetlana?
You have about 5 minutes.
Okay, perfect. Well, the magnitude, especially when the dimensionality of X gets big, the likelihood that you're going to find evidence of predictability is really, really high. Okay, so that's one of the quite striking things here. And even over a relatively reasonable number of time periods, and here think of these time periods as being decades. I think that's the calibration that they suggest, which seems reasonable to me. You still find a lot of apparent predictability, which isn't really there. Okay, now in terms of, Stefan went through these, luckily I correctly assumed he'd present them in a very, very good way. So I'm just going to quickly summarize some of the things that I find very cool. In-sample predictability does not imply out-of-sample predictability, okay? The other thing that's striking is that as J grows, okay, I should have said as N grows, the in-sample Sharpe ratios go to infinity. And if you think about it, this characterizes a lot of our anomalies, right? They're not very large in terms of magnitude, but they're really large in terms of Sharpe ratio, but that's because we got a lot of assets, okay? One striking thing that Stefan talked about is you don't get either forward or backward predictability. So Juhani and Mike Roberts have a paper that shows that patterns are different in the past than in the future. Well, at some level, yeah, that should be obvious once you think about it in the context of a model like this, okay? But now what I guess I'm really supposed to do is to think about, okay, is this to what extent could this fully explain what we're seeing? Again, Stefan did not suggest that this can explain, but I think what would be really cool would be to think about learning in the broader context of the other explanations that could potentially explain how these anomalies vary through time, i.e. the limits of arbitrage or the increasing arbitrage as we find out about this, or just the data mining explanation. And this is something that Stefan suggested with the introductory slides, but one of the things that characterizes the changing environment for us is not only the increasing number of variables that are available to us, but also how much access people have to the technologies that would allow you to run quantitative strategies like this. Okay, so now let me just quickly talk about this. One of the things, remember, that this model implies is there's no persistence, okay? You see it in one period, you then don't see it in other periods. Well, I'm not sure that a lot of particularly the robust anomalies, and I'm going to include the ones that Fama and French presented, are consistent with this. So for example, for momentum, we've got pretty consistent evidence that, in fact, let me argue for both value and momentum, there's fairly strong evidence that across multiple time periods, multiple asset classes, where at least in theory, the parameters should be different, you see very similar effects. Certainly for momentum, I've cited 3, I think, very cool papers here, including Getzman and Wong, which looks at momentum in Imperial Russia and finds not only is there momentum, but you see momentum crashes that look like the crashes you see in other geographic and environments and time periods. One of the things I was trying to think through, what would this model imply? Well, one of the things that we know characterizes, I think characterizes the asset pricing environment is limits to arbitrage. If this is what's going on, limits to arbitrage shouldn't really matter that much, okay? And I'm going to argue it instead plays a fairly significant role, okay? This is a plot showing the cumulative returns to the dark blue line here is T-bills. The light blue line or the teal line is the market. And then the purple line is a Fama French HML strategy, okay? So you can see here, the HML strategy worked pretty well. Bear in mind, this was close to uncorrelated with the market, but certainly in recent years, we see this, what I already showed you, that HML has been a disaster, okay? Well, for those of you who work in low-tech asset pricing, you know there's a dirty little secret about HML, which is actually, it's got two parts. It's got a small cap part and a big cap part. And in fact, if you break HML up into those two parts, what you see is large cap value never worked. Okay, in fact, basically you did about as well as the risk-free rate, but small cap value worked really, really well. Okay, nonetheless, there has been a significant decline, but I would argue there's what looks like a lot more persistence. Okay, let me talk about one more thing. What's the idea behind HML? Well, the idea behind HML is you're going to kind of figure out what the firm is worth. What's the present value of all the future cash flows? That's book. And then the price represents what investors are willing to pay for it. That's kind of the old Graham and Dodd formulation, okay? Well, one of the things that we know is that what is captured in book, okay, the fraction of firm value that is captured in book has declined significantly since the 1970s. So this is a plot that comes from an accounting paper, Anachi and Srivastava, okay, that shows that basically intangibles have become much more important. And there's a new literature in finance and economics that has looked at intangibles. And in fact, let me talk about one recent paper by an accountant, Park, that's actually coming out in the Critical Finance Review. And they take some estimates of intangible capital from a Peters and Taylor paper that some of you may know. The Peters and Taylor paper, the reason Huna Park uses this is the Peters and Taylor paper looks at the declining relationship in the link between firm Q and investment. She doesn't look, or excuse me, Peters and Taylor does not look at return predictability at all. So Park says, well, this is great because this is a model, right? They basically fixed book value for me. So let me go back and fix book value in the Fama French portfolio formulation and see if things get better or not. Because based on this last slide that shows that intangibles are more important, okay? And the idea we can fix book value, okay? There shouldn't be data mining here because at least when Peters and Taylor's wrote their paper, they weren't paying attention at all to return. So let's see what happens. Well, here, okay, I'm almost done. The green and blue lines are the lines you saw before for small cap value and big cap value. But basically what you see is once you add in intangibles, and in other words, form the portfolios based on the ratio of price to intangible adjusted book value, things work a lot better, okay? And particularly when you go to really small cap stocks, okay, where limits to arbitrage are admittedly very, very high, basically what you see is there's no decline in the predictability whatsoever, right? So this suggests that, I just wanted to show this chart, which shows that, by the way, the limits to arbitrage here are really, really high. This shows the costs of borrowing for particularly these really small growth stocks is huge. So making lots of money off of this is difficult, but I would say a learning story is going to of this kind is going to have trouble with this explaining facts like this. Okay, now what I guess I'm really interested in is thinking about, I mentioned earlier, and I'll finish, this is my last slide, Svetlana. I was in industry in 2007 when there was something called the quant crisis. And I remember an interview with Cliff Asness, who runs AQR, and Cliff was saying basically he was spending all his time that week trying to learn what everybody was going to do, which I thought was a fascinating statement. As you guys all know, Stefan has this really cool paper with Markus Brunemeyer, where he shows in the late 1990s that there were hedge funds that basically rode the tech bubble up and then got out. And I've always found that fascinating because I don't think we have a very good understanding of how these hedge funds that were successful in this learned about forecasting shifts in sentiment. This market is incredibly unstable. In fact, if you look at the recent price moves in GameStop, Bitcoin, what you see is this is an incredibly difficult thing to forecast, right? I mean, Bitcoin was up, what, a factor of 3, I think, yesterday. I don't know what's happened in the last few hours. So I think a model that integrates learning about sentiment, conditional on the environment, and the kinds of patterns that can be generated would be absolutely fascinating. So this is a great area. This is, I mean, I think I learned a lot reading this paper. Thank you to Stefan, and thanks to the organizers of this great conference. I will stop there, way over time. Sorry, Svetlana.
Thank you very much, Kent. I would like to remind everybody that if you have a question, please use the Q&A option. You can also raise your hand. Stefan, while we're collecting questions, would you like to take a minute to respond to some of the comments?
Yeah, let me just briefly say, thank you very much, Ken, for these great comments. I basically agree with what you said. Of course, we're not saying that, this is the entire story of what's going on in the cross-section of stock returns, but we think it's sort of one, among the set of possible explanations, it's one that's important to consider. And maybe we should, think about maybe doing our empirical tests somewhat differently going forward. On your last point about generalizing, I fully agree. I think, in our model, investors only learn about the fundamentals, they're homogeneous. That's obviously not quite a realistic description of the world. There could be lots of interesting things that could happen if you have more heterogeneity. Maybe some people learn about fundamentals, some people bring in noise flows, and then some investors have to try to learn about those flows, or try to learn from past price information about what's going on with flows and sentiment and so on. And so I think this is indeed exactly where it should go, sort of as the next step. Thanks.
Great. We have a question from Gustavo Schwenkler. Gustavo, please go ahead.
Yeah. Hi, Stefan. Thank you so much for that very nice presentation and the discussion as well. My question was mostly around kind of a lot of the new results that, say, Bryan, that Jiang, Markus, and other people have kind of obtained by using kind of machine learning to assess predictability, is that nonlinearity is really important. And your model, I guess, in parts is very linear, partially because that's kind of what you need for these Bayesian kind of frameworks to work. I wonder what you think about whether there's a discrepancy there, whether it's kind of the discrepancy that your model can allow for some nonlinearities and things would go through, or whether the discrepancy is more like the fact that we're finding nonlinearities is because we don't really take into account the learning that's going on that you're pointing to.
Yeah, so I would say, if you include some, let me put it this way, the way we have set this up, we have in some ways still drastically simplified investors' learning problem relative to how it looks like in the real world, right? We assume this linear function between characteristics and future cash flows, and we assume that investors know it's a linear function. If you take this knowledge away from investors and just, even just include the possibility that they should entertain that it's possibly nonlinear, or you, on top of this, maybe introduce some actual nonlinearity, I think this would further increase the difficulty of investors' learning problem and would probably enhance these effects. I'm not sure I can say anything more precise beyond that at this point before actually, writing down and trying to think about a model that incorporates this kind of nonlinearity. But this would certainly be the tendency, that it would kind of enhance these learning effects in asset prices.
We have another question from Praveen Joseph. Praveen, please go ahead.
Hi, Stefan. Thank you for that great presentation. So my question is kind of, I think, follows the earlier question. If you look at the problem of, how would the problem of learning G change if we use nonlinear deep learning models that can achieve essentially representational learning from very large feature sets of J?
Yeah.
And from a practical point of view, I'm a market investor, and when I'm modeling these, I'm thinking about it from a practical point of view. As an investor, do I really need to know the form of G, or can I just rely on the model to produce as long as I can produce reasonable or attractive out-of-sample predictions on returns?
Yeah. So again, I think we gave investors here, in a way, an advantage that they probably don't have in the real world, which is, when you do know that a model is linear, this does help you get more precise estimates. So if you take this knowledge away from investors, this would increase the statistical uncertainty they have about these predictable components of cash flows. And so I think it would be really interesting to take the model kind of in this direction. The reason why we wanted to start with a very simple Bayesian framework is because there we know exactly what's optimal. So if we then find some return predictability, we know that it's not because investors somehow made a mistake. Once you go to allowing complex forms of nonlinearity, it's not entirely clear what the optimal thing is for investors to do, and so you don't have such a clear benchmark. That said, I think it would still be very interesting to go and just see what happens if we throw investors into a situation where there's nonlinearity, and then they maybe just use some of the typical tools from the machine learning literature for dealing with this nonlinearity, right? I think it would be interesting, but we wanted to start with at a point, at least as the first step, where we know exactly what the optimal thing is that investors should be doing.
Great. Unfortunately, our official time is up. I would like to thank everybody for joining us today. And of course, special thanks goes to Stefan and Kent. Let's give them a virtual round of applause. We hope that you enjoyed our session today. And we very much look forward to seeing you all next month with Laura Veldkamp and Ezra Oberfield discussing the growth model of the data economy. We are stopping the recording now. We hope that you can stay for a few more minutes and join our informal post-seminar discussion where you can ask follow-up questions. We're going to upgrade all the remaining participants to the panelist status so that we could all see each other and have a nice chat. To everybody who joined us today, thank you very much for coming. I wish you a very nice day.